Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So we got to talk about today's U.S. jobs report, okay? I think this is a very telling sign. Today, this number that came out, weaker than expected, telling you that the job market is getting weaker. We also saw signs from the market, stocks and bonds today, signaling fears that the economy is getting worse off. I think today was a signal that we could finally say that yes, we are in a recession and things are getting worse off. And I understand you may get angry before you do, posting any comments in this video talking about that, hey, we're already in a recession and blah blah blah. It's been many months and so forth. I understand. Just check out my videos on this channel for the past year or two. I've been talking about how things are getting worse off. But the important thing here is that this jobs number that just came out solidified more of what I've been talking about for 2 years, that the economy is going to get worse, and we got the signal today. The SOM rule got triggered today. The SOM rule basically says that when you look at the unemployment rate over the year, and when you get an average of 3 months, when that number is above 0.5%, it signals that we are in a recession. And when you take that SOM rule and you look at how that SOM rule has played in the past, it's been very accurate. We had also the yield curve started to steepen, started to get very close to turning positive, also signaling, and it's been a very good predictor of recessions and so forth. And of course today, which is why I'm doing a video right now, talking about the jobs data that came out. All right, it came out worse than expected, less jobs. We have yet to see it get worse. Okay, this is the thing, it's going to get worse. We have yet to see a negative payrolls number, but the signs are there. And if you look at the jobs number, the revisions, the previous numbers also came in worse than expected. We've seen previous revisions in the previous reports of the past couple of months showing more weakness every time we get this report. But most importantly, what I do want to talk about is the unemployment rate. Did you guys notice the unemployment rate on that report? Very interesting there. The unemployment rate sitting now at 4.3%. Okay, why is this important? Because that 4.3%, like I said in the beginning, triggered that SOM rule. The point, when you get the unemployment rate rising 0.5% above from its year's low, it basically signals that recession. We're in a recession. We're here. Recession's coming very soon. Another very important thing is that the Fed, in its last projections, they had a table where they project where interest rates are going to be, where inflation is going to be, where the unemployment rate is going to be. And in that chart, it showed the unemployment rate for this year. They projected to be 4.1%. And they projected next year to be 4.3%. And what did we get? We got 4.3% now. So above the Fed's projections. Fed's projection was 4.1, but we got 4.3. And if you remember in Powell's testimony about a year or two back, you had Congress members grilling Powell about that unemployment rate, saying that, hey, you project the unemployment rate to go up 0.5%. And as we've seen in history, whenever that happens, we see a crash, a plunge. We see that number get worse off, the unemployment rate really skyrocket, and jobs to get worse, economy to get worse, and always a recession. Okay? Now, we had a Fed member today come out and make a few comments on the jobs number. They basically said that, we don't want to get carried away with cutting rates too early or too soon, right? However, if the economy gets worse off, we're ready to do something about it. And because today the stock market was selling off and the bond market was going up, you had traders start to price in that in September, because this week when we had when Powell came out, he didn't cut rates. And he also, kind of threw cold water on the idea of some sort of fast rate cut to come soon, and possibility that September we could do a rate cut, but it's all dependent on the data, right? And it wasn't that dovish as people would like to hear Powell be. So the fact that it was kind of, I would argue, a little bit of a hawkish event, we had a Fed member come out and basically say that after the jobs number, say that 4.1% above an unemployment rate above 4.1% is not good, and that would warrant some sort of action from the Fed. Basically telling you that September, most likely we're going to see a rate cut there. Now, the markets and traders are expecting a 50 basis point rate cut. What's been penciled in from the Fed is 25 basis point for, not 25, 75 basis points by the end of the year. So 3 rate cuts. So that could mean September, that could mean, November, December, right? Now the markets are projecting that you're going to get a 50 basis point rate cut in September rather than a 25 basis point. And last time we saw a 50 basis point rate cut, a quite drastic move in terms of the rate cut, was 2020 during COVID time. And then when you start to see those emergency rate cuts come in fast in big chunks, that means there's a problem in the economy. Okay? So the jobs data is telling you straight blank that the economy is getting worse. You have tech companies reporting this week selling off. Some of them reporting good earnings, but misses in certain areas like cloud and so on, but still selling off. It's not good enough, right? You had basically Intel come out, aggressive sell-off in the share price there because the earnings came out worse than expected. They halted dividends. They're not gonna give any dividends anymore. And on top of that, they're laying off 15% of their workforce. The companies out there that are reporting earnings are saying that if we don't get some sort of rate cut, things are not getting better, we're not going to hire. We're going to continue to lay off more workers. Things are going to get worse off. And then you have the Fed, who's, I would argue, way behind the curve, should have cut rates this week, and is probably already have made a policy error, which is probably going to result in a very worse off situation for the economy. And the economy, probably we're going to see some sort of major contraction. Okay, I expect in probably the next 12 to 18 months a very hard landing in the economy, a recession, a crash to come. And, it could come very early. It could come as close as September, right? What did we see in previous election times, right? We've got the elections coming up this year, September. But what did we see back in 2020, in 2008, in the dot-com bubble, 2001, right? 2001. During the elections time, we saw a massive crash. We saw some sort of event that happened that caused also stocks to drastically sell off. Could we see the same this time? Possible. And the bond market is alerting that. Now, what's also very, very funny is that you had the Nikkei, right, Japan's stock market, sell off 6%. And Bank of Japan is still talking about rate hikes, not even cuts, rate hikes, which is hysterical, which is funny. No way in this scenario where you have the Nikkei sell off 6%, where the jobs in America and around the world, where everyone's cutting rates, Canada's cutting rates and so on, ECB and many other central banks out there are cutting rates. And then you have Bank of Japan saying, we're going to hike rates. Yeah, right. You're going to see very quickly how things unfold, and Bank of Japan also start to come out and, go from talking about rate hikes to now, okay, we need to cut rates. It's funny. It's very funny because, anyways, I'm not even going to get into it. But the signs are there. The signs are there. You have Bank of Canada already cut rates twice. They're going to cut rates again, okay? It's getting worse in Canada. You had, stories and some news come out that repo facilities from the Canadian banks are being utilized, saying that Bank of Canada had to inject something like $70 to $90 billion for one of the banks. I believe it was RBC, because there was some cash issues there. You have refinancing coming up for a lot of Canadians the end of this year and next year, and rates are still high. I mean, Bank of Canada is not going to do any emergency rate cuts and bring it back to zero unless something really bad is happening in the economy. So that means by the time renewals come up, that means you're going from a very low interest rate environment to a higher interest rate environment, coupled with job losses, weak economy, and more future job losses, resulting in the unemployment rate going up. And the unemployment rate in Canada is already 6+%, and it's moving up more. Okay? China is already in a worse off scenario there too, doing a bunch of rate cuts there, pumping stimulus money into their economy. Their stocks are selling off as well. The economy is doing worse off. Demand globally is getting worse off. Look at oil. Oil's been selling off as well. On the, again, the economy play, the demand play. The bond market is just going through the roof, shooting up higher as people move into safety, right? Looking for more of a safe haven play. The signs are there. And all you got to do is just read into the numbers, look at the unemployment rate, look at what's coming out, right? Don't be fooled by the politicians. Don't be fooled by, certain commentary from certain Fed officials that may be eye-washing certain things. It looks like something has broken, and it looks like this is just the start. This is just the start, and things are now snowballing down the hill, and you're going to see it in 12 to 18 months. Who knows? It might happen, very soon too. Possibly September. Let's see, right? But it's gonna have its play. You're gonna get those rate cuts, and then you're gonna get those emergency rate cuts, and then that's where things just go haywire. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified in the next video, and I'll see you guys around. Cheers. Bye.